Live. So yeah, I'm so glad to have you, Andre. Thank you and welcome to my channel. I just wanted to talk with you. I wanted to bring up a few topics with you in regards to tokenization, in regards to automated services, DeFi, trade finance, and a whole host of different topics that I think would be really interesting to discuss. I remember last time we got a chance to meet back in Austin for the XDC convention, and I kind of wish I got a little bit more time to chat with you, but there was just so many people and so many things going on. So it's really nice to be able to have this time now to pick your brain on a few topics. And one of the first topics I wanted to bring up, was what does the world of trade finance look like now, and how can we make it more efficient and revolutionize the way that we're able to issue settlements and assets on chain. We talk a lot about DeFi and trade finance, but what are some of these traditional systems that are being replaced with these tokens, these assets, these settlement mechanisms? What does that world look like now, and what could it look like in the future?
Yes, so thank you, Quincy. Great to be on your channel. And indeed, the on XDC conference in August in Austin was terrific. First edition. I'm keen to get back next year or run it in Europe. So basically, the state of play in trade finance is basically can be defined by one metric that the industry knows very well. And this is the trade finance gap. Basically, what is happening is that we rely on banks too much to offer everything and anything regarding financing and payments and FX. But banks have their own limits. In particular, following the global financial crisis of, is it now 16 years ago, of 2008, the banks were under increased regulatory obligations to become more sustainable, more solid, and that got them to focus on the on core markets, core clients, core market, core geographies, which is why the banks have left a lot of geographies, markets, and in particular the lower volume clients, the clients that are expensive to handle because you need to check their profile and so on, onboarding them, and that comes at a cost. And if the volume of activity is not good enough, basically they're losing money on those clients. So the banks moved out of various markets, in particular over the last 16 years following the global financial crisis. There's always a reason for things to happen. And that has created a gap, a funding gap for those smaller clients, we can call them small and business enterprises, SMEs, and that gap is measured as 5 trillion, basically US dollars in value, that of funding that the SME market is lacking because the banks are not able, for different reasons that I explained. There are others as well, of course, to serve them. So where does technology come into play? Basically, it's not just technology. It's making sure that new players can enter the market and address this requirement. Because when there is a need, there is a fair need from the market, there is a solution coming. But that solution might not come from the banks for the reasons I explained, but from new players, new types of funders getting into the market and funding, not becoming banks, but funding the SMEs. And this is where technology comes into play, because when you have new players coming into the market with a fresh perspective, there's no legacy practice, legacy technology, and they can start working with completely new IT systems and basically very recent technologies. And this is where basically we see the role of some blockchain applications becoming more and more relevant, because basically what blockchain offers is an ability to digitize much more processes than ever before. And I can go deeper into that, but basically you can do many more things in terms of payments, in terms of exchanging money, in exchanging collateral, and we can talk more about that. At very lower price points and cost than before. So less manual interventions, less paper, more digital transactions than before, And that's what the new players are expecting basically from the technology, is to make the life much more efficient and cost effective as well.
No, that is amazing, actually. So sort of just to summarize, a lot of these technologies can automate a lot of these already established services and fill a funding gap by allowing anybody to now participate in these different, let's just call them investment opportunities or funding opportunities,
Yeah.
as opposed to rely on giant major players, giant major banks, people with a lot of capital and a lot of, whether it's connections or relationships. Now anybody can essentially create a service or whatever and be able to have anybody else be able to, whether it's funding, investing, whatever, rather than having to go to these giant organizations that traditionally would be the ones to do that.
Yeah, and this is the case on XDC. You have TradeFinex, which is inviting corporates basically to take advantage. TradeFinex is a kind of alternative lender where you have basically corporates who can rely on new types of funders in the primary space, really between SMEs and funders, through a tokenization mechanism, basically. And it relies on traditional practices of securing, potentially with a credit insurer, potentially with an electronic bill of lading as a collateral, to have ownership of the goods when you're financing a transaction, just as a collateral. But it's definitely about basically enabling new types of players, non-bank players often, to get into the market and allocate liquidity to SME requests, really adding many more funders to the traditional banking market, because you can't expect everything from banks. There is a limit. It's not the role of banks to offer all of financial services. Many financial services over time are going to be offered on the payment side, on trade side, by non-bank institutions that are taking risks to execute payments, to finance corporates, SMEs, and basically they don't want to become a bank, but they are happy to basically serve those who need money by lending money.
That's interesting. That's interesting. I really like what you said about some of these banks offering financial services, and it almost seems like that's sort of like the default stance. Well, since they're a bank and since they offer some financial services and everyone goes to them, they offer quite a few. But now you can have independent brokers be able to offer similar services, analogous services, without necessarily having to go to these giant organizations. But at the same time, you may be able to find more competition. You may be able to find better rates. You may be able to find more liquidity between different trade partners. So instead of having to rely on just one organization to be able to facilitate these services, you can have a marketplace of individual brokers or individual parties being able to facilitate these services, ideally more efficiently, ideally programmatically. But I almost forgot the last thing I was going to say. And then to address another thing you stated, the tokenization process is a lot more than just having like an asset on chain. You stated before that someone may have a token, they could use that as collateral, and there are other services that can be utilized with these tokens outside of just the token existing, whether it's being left as collateral or whether it's whatever it may be. There's a multitude of different services that can be done with the individual assets that are listed on chain. And these services can be done by third parties as opposed to these traditional banking organizations.
Exactly. Yes. Basically, you tokenize in order to hold the asset, to confirm the ownership of an asset. You tokenize this, and of course, this is as per a contract law or a common law, because the legal environment is of paramount importance here. It's not just about technology. So you tokenize something. Take gold. You can tokenize gold and leave the gold, the physical gold, into a warehouse, a regulated warehouse. You know it's secure, and basically you can, once you have your token, which is regulated, and identifying your ownership of gold, then you can basically put this token as collateral to get a loan. Because if you don't repay the loan, the token will be transferred to the lender to repay the loan, basically. So basically what we could never do in the past, because it was too physical, too costly in the physical world, too risky, and we cannot do thanks to more accessibility to assets, because when you just have a token on your mobile representing gold as an example of an asset, you can sell the gold much more easily at a lower cost. You don't need to move the gold; it stays in the warehouse, but you just sell the token basically, and the token is the right to access the token. But it requires a legal environment, which is why we're working through the tokenization efforts and other digitization initiatives. We're working a lot with regulators, because regulators have to embrace this tokenization option in order to open up new markets. Otherwise, it's just a piece of technology with a lack of protection for the users. I have another example next to gold, if you allow me.
Yeah.
This is art. Art, for instance. I mean, art is an asset class. You can buy art. You can resell art, but sometimes you can't basically sell the whole piece of art. So sometimes you could have fractional ownership of a major piece of art, potentially get a yield if that piece of art is actually generating some yield in a museum or whatever, or basically just trading art and buying and selling. But if you can't, I mean, this asset class is for ultra wealthy people usually. So with tokenization, we can actually reduce the cost of ownership, because the tokenization and the blockchain enables you to own a piece, be a thousands or hundreds of the piece of art, and only pay for that fraction basically. But again, it needs to be regulated, and it offers you to be an owner of an asset class without being in the wealth category that usually is required to get access to that asset class.
Yeah,
basically.
actually, it does two things.
Many
Oh,
more
sorry.
use cases.
I was gonna say it
Yeah,
does
many
two
more
things.
use cases. Yep.
It provides more liquidity to that given asset, because now where you would have to wait for one big buyer, you could have a bunch of smaller buyers all come in and be able to provide that liquidity. And you now have the availability for a set of different investment vehicles that people would otherwise not be able to have access to. And that there's a whole host of different vehicles like that. I remember having a conversation with a coworker not too long ago about tokenization, and one of the examples they used was like a power plant. Like, let's say like in Spain somewhere, they're setting up a major power plant, and these things take like potentially 20 years to construct. The total amount of capital that comes in to put these together is a huge amount. The different amount of parties that may come together for this investment. There's so many different things. And actually, one thing I almost forgot is, because this was in the conversation we were having, with the fractionalization, not only do people have liquidity to get into the asset, but they have liquidity to get out of it as well. Where like the power plant example, if you had to invest in a power plant project for the next 20 years and you are just locked into that, well, you just have all this capital that is very much locked in to this one endeavor that can't be used, be working elsewhere, or can't be liquidated or whatever. And being able to have this fractionalization allows for that additional level of liquidity in terms of being able to redeem or be able to sell a portion of the asset before the maturity date of whatever it may be.
Yep. Exactly. So it's providing access to multiple new asset classes to the masses, offering those asset classes, as you said, new investors, because they are becoming accessible, and basically reducing the cost of the whole processing. Because today, and we got used to it, in the equities fixed income world, when you're investing, you have a lot of costs, one-time cost, annual costs. This is because the whole process is still very manual. That was invented in the 50s, 60s. Some pieces of it have been automated and digitized, but not everything. So you still have huge, basically, organizations acting as manual processing plants to handle the trading of assets. Sometimes the payment requires 3 days when you're selling an equity, or in some countries the settlement is far too long and expensive. So with the blockchain, we digitize a lot of those processes and basically reduce the cost of trading, which usually makes it also it's critical for new investors to come in.
See, that's
Because
that's
imagine
actually.
you want to,
Oh, sorry. No, continue.
yeah, imagine you want to invest 100 euro or 100 US dollars in a particular new asset class. If the cost to get access are 500, of course, the investment is not worth it because you will not invest $100 if the cost to entry is 500. I mean, that would be foolish because you're losing your whole, I mean, you're not funding enough to get over the barrier to entry. And that's what we are able to achieve, not only in trade finance, but across all asset classes, to lower the cost of processing. This is why the capital markets industry is very interested and embracing quickly tokenization and smart contracts.
That's interesting. Hold on, I wrote a note down. Yeah, so I think one thing that's actually like really interesting with these with tokenization being a hot topic and with all the things that can be done with it in regards to automation, in regards to like extending liquidity, extending access so people can be able to trade. I think one thing that almost gets a little underrepresented is I think one thing that is a little bit underrepresented is this allows for one thing that gets brought up a lot is accredited investors. That's what it is, accredited investors. And usually because there's a class of investments that investment vehicles or whatever that they can participate in that regular people typically can't. And I think and most of that typically has to do with capital requirements and understanding of the investment and so on. But a lot of that, like what you were saying, is the capital requirements. A lot of people simply just don't have enough money to be able to justify certain investments that would otherwise be illiquid, and that fractionalization not only adds that additional liquidity, but that access is huge. And the reason I bring this up is I think there are, how should I put it? I think tokenization will do to retail what Robinhood did to retail. And what I mean by that is Robinhood created like the average retailer that can get into options, trade, all of that. And it was a format that allowed for people to engage in these financial markets in a casual way. And I think the same sort of thing is going to happen with tokenization. And it may be tokenization on Robinhood, who knows? But the thing with tokenization is there's so many investments out there that are illiquid. Like a simple example could be startups. Right now, regular people can't invest in startups. It's almost impossible. Maybe if you have a little bit of capital and you happen to know somebody and you happen to be an angel investor, maybe you can get in. But for right now, there's no real way to. And that's the thing. I think that's where a lot of money gets thrown into, and a lot of productivity and a lot of different products and services being built. But being able to, let's say, like tokenize pre-seed equity or tokenize Series A equity and allowing regular people to be able to participate could be one of those mechanisms to allow people to have access to not only otherwise illiquid assets, but assets that they would otherwise need some sort of capital requirement just to be even considered.
Yes, and some people would tell you actually you can do all of this today. You can, as a retail, get access to someone, an institution who will offer you access to seed. But that intermediary is creating huge costs.
Yep.
Because they know they are
Friction.
essential in the process, and they know they are making the asset accessible to you, so they're taking a huge margin on the deals. With blockchain and the tokenization, those illiquid asset classes could be, again, art, gold,
And it's peer to peer, so
gold,
there's nobody to
real estate.
yeah.
Yeah, it's all of those can be put on the blockchain in a fully digital way. The blockchain is the intermediary, but the blockchain will fight against other blockchains. There are so many now these days, layer 1 and layer 2 blockchains. They will find to offer the lowest cost and the fastest processing, because the blockchain is the intermediary, is the notary between the asset seller and the asset investor across any asset class. And as you said, basically, it's nice to get access to an asset, with your example of the nuclear plant, but it's nice to get out of the asset to be able to sell. So that's also the important when you buy something. Again, whatever you buy, you need to think about is there a liquid market to sell it to in a few weeks, months, or years from now. And this is what blockchain also wants to achieve, is to increase, scale up the number of investors in particular asset classes. And make sure, because the larger the community of investors, the larger your chances to be able to sell the asset you have invested in, basically. So we are digitizing existing practices. Fractionalization of real estate exists since years, but it's costly, and you won't invest for 500 euro in a real estate project on a fractional basis, or if you do, the intermediary will take such a margin that the investment will not be worth it. So we are improving the existing practices with blockchain. That's why capital markets is so interested in this. And we are also opening up new asset classes, in particular the illiquid ones, as you said, to new investors.
Actually, with what you're saying, with what you said there, it kind of makes me want to go into my next topic, and it has to do with these different categorizations of whether it's real world assets. We like to talk about securities and equities and commodities and such. But there's a whole host of different classifications. You know, maybe some are carbon credits or some are whatever it may be. What are some of and I only ask this because I can only think of so many examples. But what are some not so common examples that people can use to understand tokenization? Like, it's one thing to talk about a security or a stock or like I said, even a carbon credit, but in the idea of tokenizing anything, we talk about supply chain tokenization, we talk about identification tokenization, documentation tokenization, and I just ask this because the more I sort of like acclimate myself to the space and get a better understanding of all the things that can be tokenized, I start realizing that there are very, very, very specific like units of account in a multitude of different fields that can be tokenized, but unless you're in that field, it wouldn't even cross your mind.
Yeah, so tokenization can be used for tracking the life cycle of an asset. So you have a contract that has multiple versions, or you have a bill of lading in the transport world, sea transport, they have bills of lading, and the owner can change because the goods on the ship are traded during transport. So the owner is changing, so the bill of lading is changing in terms of its content, and each version on the blockchain is tracked as a new version. So tokenization can be used to track a document lifecycle, version control. And that's what we do in trade finance, in particular with the DNI initiative and the whole digitization
huge,
of trade documents.
No, that's huge because oh, sorry. I was just gonna say
it's a very basic use case.
Sorry, no,
it's
you
very
go,
basic. Yeah, it's very basic use case, but it's key for traceability, and that's the first use case.
Yeah. Being able to secure the integrity of a specific document over the previous versions is huge. Like, that's just something that, like, the immutability of the chain just allows for. It sounds like a very simple use case, but that use case can be used in a multitude of different ways and in a multitude of different angles. Because, you know, maybe it's tracking a bill of lading or a contract, or maybe it's just tracking a sea of documents or something. And every time somebody passes a new document or passes to a new person or some information gets updated, you could have a hash or you could have a version or whatever it may be on chain. And that version, and I only say that because I would have never thought of that. I would have been like, oh, actually, yes, that's a huge thing, actually, version control. And you don't even need the versions. You just need to verify that this correlates to each, like whether it's a hash or something, whether it correlates to a previous version, and be able to track that. But yeah, that's like a huge thing, and the average like retailer wouldn't even think of that. But then you start thinking of all the different enterprises and services, sort of like you said, these third party automated like financial services that can provide these type of products, as opposed to, like I said, the banks.
So that's a first use case. The second use case is the payment. I want to send you money, And on blockchain, that can be done as well. You can tokenize US dollars, USDT, Tether, USDC, and many other stable coins. You can create your own token, like the XDC token, for instance, and XRP and all the others we know, Ether and so on. And by exchanging those, you're paying someone, basically, because there is value and there is usually a huge market in terms of liquidity, with some volatility, as we know. And then the third one is what capital markets is really interested in, is basically organizing delivery versus payment. You want to sell me something, and I want to pay you something, but we need to synchronize the exchange of the asset, the real world asset. It could be indeed a fractional ownership of the something or a bond security, and the money transfer. And this is delivery versus payment, which the industry is using since 70 years on electronically, but still very costly because some of the pieces of the process are manual. And that's where smart contracts come into play, whereby we synchronize the exchange of the asset, the ownership, with the exchange of the money, the value, the payment.
No, that's and I think that's like one of the core things that's spoke about with blockchain. But I think one thing that even adds a extra layer of like sophistication to it. Not only can you use the native cryptocurrency as a form of payment to engage in these different exchanges, but it's a neutral currency that anybody in the world can engage with now. So traditionally, you would have to opt into whether it's the dollar or whatever local currency to be able to do so. Being able to use smart contracts and being able to use the native currency allows you to be able to facilitate this payment programmatically, facilitate the actual swap or whatever the engagement is, and you can do it with anybody. So it's not like you're just subjugated to people that are in your country or use your currency. You can do it with literally anybody, anywhere in the world, and very easily have access to these new markets simply by being able to interact with these smart contracts.
Exactly, because indeed the tokenization and the blockchains have no borders. Unless the regulators put some borders, of course. And then the final use case, and I've documented that in an article about a year ago, is the investment contracts. You create a token that represents an investment, a bet, basically, on a particular asset that is expected to generate yield. And that's an investment contract, like you're buying a bond or an equity,
So like
and
derivatives.
tokens launched. In the US, for instance, you have a lot of tokens for US treasuries, like the ones we have launched with XDC and Securitize and TradeTech, called YieldTech. This is a token that represents ownership of a US treasury, and that is generating some yield. And you just can check on the YieldTech website for more information.
That's interesting. That's
It's an
interesting.
example.
And I believe the issuance of these yields are programmatic, so you don't necessarily have like these. I don't even know how to describe it. These different intermediaries that try to distribute payments because they're able to do it on chain.
I mean, more and more, indeed, the whole goal is to get all of those processes on chain. Sometimes it's only a piece of the process that is on chain, like the tracking, as I said, for the basic use case. Sometimes it's only the payments. Sometimes it's the whole investment product or the DVP settlement. But basically, you can start using blockchain in a very incremental way, gradual way.
Gradually. So with it being with okay, so actually this goes into sort of my next question. And I really want to pick your brain on this. So with there being like the gradual adoption of different blockchain technologies, people like to talk about adoption this, adoption that, utility this, utility that. What are some of the first use cases / products that we're going to see in terms of just general adoption? I know there's a lot of regulatory unclarity, but just in terms of just functional like uses, like you stated before, like version control or listing assets, or what have you seen in your own professional life? Some of the first things either being tokenized or how they'd go about utilizing these.
So yeah, the basic ones are the tracking of the life cycle of an original document. because it doesn't. It's not a regulated workflow. It's not a regulated use case. You don't need to get usually, maybe in the US you do, but usually to track a document, an original document on the blockchain doesn't require regulatory approval because there is no financial flow on the blockchain. No payment being executed there, no investment contract being created or launched. So that's a basic one. That's quite accessible for banks to get started on the blockchain. The second one would be the use of regulated stable coins, because like a USDC, USDT, and all of those, because we all know, and the regulated currencies, just tokenizing them is basically also allowing to move money much easier. And doesn't lead to particular financial risks. Operational risks, yes, but no financial risks. So it's a basic use case. Also, the yield tech, for instance, the tokenization of US treasuries, it's a financial product, but the risk is very well known and understood. It's US treasuries. And you see, we are tokenizing things of the past. Trade finance instruments are definitely the past because they exist in centuries. US dollar exists also since a long time. US treasuries exist since a long time. However, there are use cases that are much more advanced because they are basically bringing capabilities that were not possible before, or serving industries that didn't exist before. And this is the example of, for instance, carbon credits, which is something that was invented really very recently to address climate change, and where basically more and more, rather than buying carbon credits in bulk, because you have to offset so much pollution and your funding activities as one transaction, more and more carbon credits are basically bought at micro level. And when we talk about micro payments and very low value flows, but high volume, the blockchain is really ideal because of the low cost of processing and the full traceability of those payments. So this is a nice, for me, Web3 use case, whereby basically the more and more carbon credits are bought for extremely low value, high volume transactions, the more blockchain will be adopted for that use case. So far, it's still lower volume, high value, but more and more carbon credits are being integrated into transactions, and like payment transactions, and that requires the use of blockchain, and preferably proof of stake versus proof of work.
Ooh, and why is that? Actually, I would love for you to go into that a little bit. Why proof of stake versus proof of work, and your thoughts on proof of work / the future of proof of work, or where people stand with it. I have my own opinions, but I'd love to know yours.
Yeah, the proof of stake is here. We're talking about addressing climate change, offsetting transactions, payment transactions by paying for buying carbon credits. That means funding climate friendly projects, and we need the full traceability of the transaction. Whereas I've paid so much money, I want to put those credits on my balance sheet, and I need traceability down to the projects, making sure the money went where it was supposed to go. And that's where the blockchain is unique in its ability to provide a public ledger of those transactions, so that everyone is clear about the use of the money, the origin and the destination of the money at very low value level, because we are talking about micro offsetting. Now, why do we need more proof of stake than proof of work? Just for the energy consumption. The performance and the energy consumption is our paramount importance here. So that's where basically the proof of stakes makes its full sense. Now, proof of work, of course, has its own value, and I think Bitcoin will, I guess, never move out of a proof of work. But then you address the issue of energy consumption through different ways. And you add a layer 2, like the Lightning Network, to basically reduce the burden on the layer 1, basically. So you create a layer 2 to take much of the load and reduce it at the level of the layer 1.
Interesting. Now, the energy consumption is a common talking point in regards to proof of work. Do you think, and this is just a general question, it's not like super important, but do you think that proof of work, I don't want to say like, do you think it'll be like viable, but it's one of those things where, do you think the energy consumption may become a problem, like a big enough problem to where they may want to consider changing? I know this is sort of like a question in Bitcoin forever, but I know that there are a lot of, what's a good way to put it? I know that the incentives for the miners don't necessarily line up well for the incentive of the network. Mostly just due to the fact that the miners will make more money by constantly like mining more and constantly increasing the hash. But at the same time, like, it ends up slowing down the network and it gets more competitive. So it just costs more and more energy to get more competitive. At least in my opinion, in my book, it feels like proof of work is. It's not like proof of work's in like a bad position. It's just that I feel like there's a potential centralization in the hash rate, and that's sort of my criticism of proof. And I know that's like a general criticism too, just due to the fact that you need more and more hash power to be competitive, and that becomes fewer and fewer. And then the question from that comes, what nation / area / whatever can have the lowest energy output but also not impact the local power grid?
Yeah, indeed, that's a nice point you're making here. I had not thought about this, but indeed, the whole point is to keep a strong level of decentralization rather than centralizing. Indeed, the proof of work nodes and creating a new risk, basically, that was meant to be removed through blockchain. So, but in terms of the energy consumption, I think it's all about making sure we can match the offer and the demand. Nature creates much energy. That's the offer. Proof of work requires energy. How can we match those two forces and basically use the energy available rather than creating energy out of fossil fuel, for instance? So I think it's all about using the nature in an intelligent way. So I'm not concerned too much about that, because there are already many proof points that this approach works. But I would be more concerned about the point you're making, of making sure the proof of work blockchain doesn't land into too few hands, basically.
Yeah, that's really the main concern, and it's mostly just the incentive of the proof of, and people like to make the notion, well, proof of stake has the whoever holds the most stake, and there are issues with there are different issues with different networks, but yeah, that's just one I like to bring up with proof of work, mostly because, at least for me, it sort of freaks me out on the network standpoint, but I know people are like, whatever, it's not to be worried about, whatever, but I like bringing it up anyway, so.
It has to be monitored, basically. It has to be visible, transparent, in terms of where are those nodes located geographically, and who are the owners. Maybe the identity doesn't have to be revealed, but at least making sure that there are sufficient owners around the world to keep a good level.
Yeah. I think all these are. Sorry, I think all these are like theoretical economic systems now. So it's sort of like we see how these networks run. We see the incentives that are played in them, and then there's sort of like, how do people interact with these incentives, and how does that reflected in the long term, in terms of long-term viability of the network, adoption of the token, trade on the network, all these different things, you know?
Yep, exactly. So indeed, I make a difference between the tokenization of existing asset classes in Web 2 use cases, things we're doing on the general internet, but that we're now tokenizing, like trade finance, like gold, like real estate, and so on. And then native Web3 use cases like carbon credits and potentially gaming in the future, or metaverses that are completely new use cases that didn't exist before, and where the blockchain nature and the blockchain features in terms of notarizing and providing immutability are key, basically.
Actually, I wanted to touch on, you stated metaverse, and one thing that I find very intriguing, and I want to see what you think about this too. So I've been speaking a lot with the Expector team. Have you seen those guys?
Yeah.
Yeah, they're really
Oh
great.
yeah.
And
Dirk, I know Dirk.
yeah, I
Very
figured
well.
as much. But yeah, so the thing I find very intriguing, especially with metaverses and tokenization, the same type of tokenization that we can apply to these different asset classes and these different objects in the financial system are the exact same type of tokenization and potentially same type of financial instruments that can be operating in these metaverse spaces. Whether people are trading asset or trading items in game, whether people are, even what you were saying, like collateral, that some of these in-game assets are valuable. People are willing to exchange value for them or willing to do something for them. And it sounds silly to like, oh, you'd hold like a sword for collateral. But the main point is, all of these are just software, and these tokens and tokenization are just objects. It just depends on what the object is for the service. So if you have a DEX and it's trading commodities and treasuries, well, that's one thing. But you could use the same code for a DEX to exchange in-game objects. You know what I mean? Or whether it's additional services that are financial in nature, those same services can operate in these metaverse spaces. And the reason I find that so interesting is sort of what you were saying before. There's like traditional finance, that's all these old instruments, but there are these new instruments. Like there have always been in-game items in games, but never before have they been able to be tokenized and be able to be exchanged for the value that they're worth. Because a lot of people may go, well, what are they worth? Well, they're worth something if someone's willing to go out and go get them or go give up some value for it. But that's the thing, though. These markets are, the software that can facilitate these is essentially the same. Like it's and I only say that because it's easy to formulate, oh, we have all these different services in traditional finance and DeFi, but it's hard to see how that same instrument can be used in other domains that otherwise weren't possible. Like I said, even the metaverse, expector component. Never before could you have like an open marketplace where people can essentially list their own items and people can engage with them freely without some sort of central entity facilitating all of that. And it's funny because the same collateral contract for the power plant could be the same collateral contract for, like I said, a sword.
Yeah, exactly. What I'm after is when I meet metaverse people, and we discussed that in my traditional world of trade finance. Imagine talking metaverse with bankers. I said to the person representing the metaverse, it was MetaBlocks in 2022. I said the bankers in the room will get interested once there is economic activity happening in the metaverse. Because there will be. I mean, if you buy, you pay. If you want to buy and you don't have the money, you borrow. There is a lender. The lender needs collateral, and we are back into lending and financing and financial services with banks or non-bank lenders. And the principle applying is nothing wrong with that. It just has to happen fully electronically. Because, of course, in the metaverse, there will be no paper being signed with wet ink, obviously. So the economic activity that the metaverse will create is what I'm after. To go back to banks and say, look, what we have digitized for the physical world, like digitizing bills of exchange, prom notes, those payment obligations, or bills of lading for transport. But certainly a prom note, a bill of exchange, what we have digitized for the physical world, is now going to be relevant for the metaverse. Because if you have a prom note in the metaverse, you have a payment obligation. And the payment obligation can be used as a collateral depending on your credit assessment. but you can have credit insurers there as well, taking that risk. So all of those functions and players and roles that we see in the traditional finance are going to be relevant gradually in the metaverse once the economic activity develops in the metaverse.
I love that
So
you.
yeah,
Sorry. I love that you
yeah,
bring up economic activity because one thing that I find so interesting with blockchain, and a lot of people don't give this enough credit. And I know it's gonna sound like very millennial of me, but have you ever heard of the game Eve Online?
nope.
It's like a space game, but the thing that's interesting about it is it has an in-game economy where it has its own in-game currency. It's not like a crypto game. It's an old game, like 10, 15 years old or whatever. But it has its own in-game economy. Has its own in-game items. You fly around in these ships and you like explore the stars and you get fuel and some people will sell the fuel and it's an entire in-game economy. So much so that there are liquidity providers that will take the in-game currency and like send you money to be able to liquidate. But they've if you were to measure the entire economy of this game Eve Online, its GDP would be around $1 billion. Just in this online game with no real liquidity in or out. It's just there's so many people actively playing that some people have elected to be these liquidity providers that take their in-game currency and send them actual currency. But these economies already exist. It's not like you need to create these new in-game economies. They already exist. And people that are familiar with World of Warcraft, people that are familiar with EVE Online, people that were aspirationally hoping for Star Citizen, all know that there could be these in-game economies where people are, and these in-game economies aren't, I mean, they can be incredibly sophisticated, but you got to remember there's a certain level of e-commerce that people want to engage in, whether it's just trading items, whether it's, like you said, lending, whether it's people coming together and investing in something. I know in Expector they have their plots and their servers and all of that. All of these are services that can be facilitated in the metaverse the same way that they'd be facilitated on chain and for any other asset class.
Exactly. That's why I believe in that development. We just need to see how the metaverse will attract the individuals, but gaming is definitely one. Potentially events, networking, traveling. I'd like to travel through the metaverse in cities that maybe I will never be able to visit, and travel in groups with the family, for instance. So that could be a nice way to experience some tourism from your sofa, basically. So yeah, there are already many use cases with all the technologies, and now the metaverse will explode that market or scale that market to many more use cases indeed. And Expector is doing great work indeed. I follow them quite closely.
Yeah, they've been honestly killing it. I actually did a stream where I went into their metaverse and I went around their town hall or town square and checked out. It was really cool. I like what they're doing. And yeah, it's funny because it's hard. The reason I find this so interesting is, especially people in crypto, there's this idea of, okay, where is it? This economic activity. And there's like a translation process because it's happening already. Like the example I like to give is VR chat. There are people that host they host DJ like spaces where they'll hire DJs and have someone pay at the door. They'll have like private spaces, private rooms, primarily to segregate themselves from kids. But they're doing and this thing, they'll do it through PayPal. So they're trying to do this in-game economy, but they have to do it through PayPal because there's no native means of transfer.
Yeah.
And they're already doing this. That's the point. Like, it's not like they have to contrive this, situation. They're already doing it. They're just doing it through Discord and PayPal as opposed to doing it natively through whatever software is facilitating it.
Yeah. No, I would be very keen to bring the metaverse back into my world of banking. We started in 2022, and of course it was very early. It was just a session with MetaBlocks and about 300 trade bankers. But indeed, the traditional banking system is evolving to digitization more and more, and that digitization is sometimes a hard sell into the physical world, but in the metaverse world, it will be a prerequisite basically for bankers to support the economic activity.
Yeah.
I'm
I
really
think
keen
I
on this
think I
long
think one
term.
thing too to think about too is especially with video games, how much money do people spend on in-game items in just regular video games? This is already economic activity that can be contributed just because people whether buy a DLC or downloadable content or buy an extra map or buy some skins or this activity is already being facilitated even in the most bland way in traditional games. It's just interesting to think of what would happen. It's one thing to have one game with one game company that collects the profits for the economic activity in this one game. But what happens when you have multiple game companies and multiple different services or assets being able to be traded between each other? And what I mean by that is, let's say you have someone in this game and they no longer play this game, so they sell the assets, from that game, and then buy assets in this game and start playing that one. You know what I mean? That's economic activity between these spaces that right now doesn't exist.
Okay, yeah, I'm not active in that space, but definitely I believe in it. Look at how Facebook has evolved. There is economic activity on Facebook. SMEs are advertising, SMEs
Yep.
are selling, and Facebook could do, I guess, much more there. But they're definitely trying with their investment in the metaverse as well, basically. So yeah, very much looking forward to those developments and how lending can be applied on chain in that space.
Yeah, I'm really interested to see what comes out of metaverse and what comes from. I'm really interested to see what type of new economic activity is going to persist on chain that just wasn't capable before. You stated a little bit earlier in the conversation. Some settlement times for assets could be 3 days, 5 days with the weekend included, maybe like 48 hours if you're really lucky. But what if you could have that settlement in seconds or even minutes or something? All that capital that would have been locked up, frozen up in transit, it relieves a lot of friction to where people can actually have access to their capital.
Yeah, and that's a key priority for regulators. Also on the US side, it's called T plus one, but should be T plus zero actually in the securities world, settlement of securities trades. And I don't know the latest about it, but basically, if you look at Europe, the regulators are working on the Payment Services Regulation, PSR, where instant payments will be mandated. That includes, you just mentioned weekends. Indeed, banking services are closed during the weekend. You can just consult, read, not write, not instruct.
Yeah.
At least not instruct for immediate processing. But this is changing in Europe with the Payment Services Regulation that will mandate the use of the provision of instant payments 24/7, weekends included. Um, to the consumer and corporate market. So this is European regulation, nothing to do with trading. It's purely for payments, but the beauty of having regulators, they can force the market to do something that might not be commercially attractive for banks, but that is very attractive for the end users, indeed.
That is awesome. Hold on, I wrote something down I wanted to ask you. Oh, actually, yeah. So I wanted to ask you a quick question. Mostly because I want to understand your perspective and how you see this. What are the significance of MT103 and the ISO 20022 standards? I know there's standards in. I know the MT03 is a Swift standard, but I know there's a set of ISO standards for message formatting. Could you elaborate a little bit on just the significance of that? Just because it's like a topic that always comes up in the space a bit, and I figured you'd have a bit more of a professional background to address it.
Yeah. First time I discovered this was 25 years ago. We first talked about it when I was at Swift about ISO 222 and XML in 1999. At Cybers in München, Germany. And look, 25 years later, it starts to be mandated to the market. Well, the European regulators have mandated for some pieces already now, about 10 years ago, but it's taking time. So does it do? Is that it's actually using the XML message formatting technology. So it's just a syntax to identify the different fields in a message or in a file. It's using the XML technology, which was invented by the IT world. Whereas Swift, when Swift was created, all of this was not so obvious. So Swift created everything by themselves. They created their own syntax with the MT101, MT103, MT940, and so on. So that's a proprietary Swift syntax that is being abandoned more and more, but not completely, only in certain markets like payments and cash management, in order to move to the XML industry standard way to identify fields. So XML is a syntax. It's a bit like HTML for web pages. It's just a technical syntax. ISO 222 is a library of all the messages for financial services. Many institutions can create ISO 222 messages. Swift is the registration authority, and that creates more structure in the message, but more complexity as well, because there are so many optional fields that corporates and banks can start using the messages in different ways. So it lowers the level of standardization in a way, because there are many more options than on the MT side. So it's just a syntax. I know that ISO 22 is kind of a big thing in crypto, like this token is ISO, this one is not. Just take it as just take the analogy of HTML for web pages. If tomorrow the industry says, oh, on the web we're gonna move from HTML to something else, well, the whole industry will adapt. But it's kind of a hidden technique to structure data.
Yeah, it's like I don't know how many people watching are familiar with this, but it's like it's no different than like some JSON data, except it's just like that schema you were talking about. So all these different organizations are on the same page when they receive this data. They receive it in the schema, and they're able to do whatever they like with it. But yeah, I always try to tell people, I'm like, from my understanding, it just seems like a formatting standard, a schema that everyone abides by. So when they send messages back and forth to each other, they can account for it
Exactly.
Awesome. Yeah, I know it's a big topic in the XDC XRP world, and I think people get really excited on things because of what could happen here, and I don't think it's that exciting unless you're like really into those unless you're into formatting standards, but it's one of those things that I feel like get overblown, and it's one thing to talk about ISO and to describe it, and I say this because I've seen a bunch of other ISO standards too, so I'm like, I don't know why we're all freaking out over this one when there's like a zillion of them. But yeah, it's just a formatting standard to allow people or to allow organizations to communicate without having to adjust themselves for every time they get a new piece of data they haven't accounted for.
Exactly.
Awesome.
Very straightforward.
I don't know how much time I have you here for. I didn't want to keep you too long. I didn't want to put too much of a dent in your day. I have a few questions if you're still open a little bit.
Yeah, let's go.
Yeah,
Indeed.
All right. Hold on, let me pull this up. Okay, yeah. So this is probably one of my biggest ones that I kind of wanted to get into. The number one thing that I see a lot of people ask is, okay, so I see blockchain and tokenization and cross-border remittance and automation and all this, blah, 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 blah. And people sort of get the wallets and the keys, but there's always this idea that comes back to, what does this mean for the regular person? And yeah, we go to like the general idea of like faster payments, faster settlements. But what ends up happening is it ends up being a bit abstract. So you might be able to see the faster payments or the faster services, but then they go, well, where's the adoption? And usually I like to describe it as people building services, and these services growing user bases, and that essentially contributing to the adoption. But without it being so abstract, like what are some ways that you think regular people could see the influence of crypto technology or blockchain technology in their daily lives? And I know it's a bit vague, but I say this because there's always this idea of like, adoption's coming, utility run, adoption's coming. But there's adoption all the time. It's just, I feel like we'll look at the Bitcoin ETF and go, but if like some, like Trade Trust, for instance, started tokenizing documents, it's not as sexy, but it very much, those services for tokenizing documents could fall downstream to something that a regular person may use, but they may not even be thinking about it. And that's something I try to emphasize a lot, but it's hard to, like I said, they're very abstract. It's almost like trying to like articulate the value of a server to a regular person. It's like, I could, but I don't know what it means to you.
Yeah, you're right. It remains very abstract. Besides, for those who invest in crypto tokens, of course, they know the feeling every hour because of the volatility. They feel the pressure of the market. Now, I think over time, what we could see in terms of very concrete use case for the end customer is having money on your phone, having a wallet on your phone that carries money, and saying, actually, it's not in my bank account, but I have here $200 on my phone, and I'm gonna pay with that. And the consumer will know that this is a wallet that holds any crypto. It could be a stable coin, so many options. And actually, more and more, the consumers will have multiple of those tokens, because for some purchases, they will need to use this token. For others, they will have to use this one. But the cash will more and more, it has already disappeared with credit cards, but the credit cards are expensive for many, for merchants.
That's why the fees are wild. Yeah, like
fees again. Yeah. So we have to replace, and that's happening in Europe, credit cards with account-to-account payment. But account-to-account can be expensive as well. So you need to account-to-account in a very efficient way, and that's where the crypto comes into play. Like all those instant payment in Europe that will be that are being regulated, they will be more cost efficient on the blockchain than via traditional players. So yeah, cash on your mobile might be the first use case for the end customer to rely on digital tokens representing money.
I think that's actually a good observation, because I think with that you'll start seeing things built on top of that, like tickets, people being able to buy and be like stuff like that, access keys, IDs, and these will just be something that's in your wallet or something, whether it's a token, whether it's a whatever. And I definitely think that's going to be the reason I say that is a lot of people may go, oh, well, what about Apple Pay or whatever. A lot of people don't understand how much it costs to run the infrastructure for a lot of these things. And that's essentially like the benefit is either you can run this giant infrastructure to manage these payments in some regard, we go back to the fees again, or you could essentially have a decentralized infrastructure, be able to manage those same fees, those same services, and be able to allow you to have ownership over your assets, essentially, because it's not in some third-party database custodied by Apple or custodied by whatever. It's on chain. This is the closest you're going to get to digital cash in your pocket. It's not possessed. It's not in an account. It's almost digitally in your pocket by a cryptographic key.
Exactly. Yeah. So I definitely believe in that case. And when I want younger people to discover crypto, I tell them download on your Android the XDC wallet. I'll send you some tokens, and now you have money on your mobile. And then they realize, oh, I don't want to remove the app because then I lose the money. So that's how I got people to realize that the money on the mobile is achievable, basically.
That's really interesting. Yeah. And I think too with that, this is actually where things can become really interesting. Just off of that small innovation, you may see it be a lot easier for third-party like services or applications to be able to monetize their applications without having to go through these crazy fees that are being perpetuated by these like organizations. So like, let's say I had a website, and let's say the website had a tip feature. Well, maybe it's like YouTube or something. YouTube, it takes almost a whole month for me to get that tip, and I might get a bit of it. And if YouTube's being slow, it may take an extra week. And that's just to get funds from my channel that someone may have tipped me. But let's say I was running an independent application, let's say it was like an independent website or something, and I had a tip feature. It'd be instant. it'd be an instant tip feature. Now, obviously, if they want to do sales, if they want to do whatever. But you don't have to you don't have to attach yourself to these third-party payment terminals like these, like Visa or credit card or whatever. Like I said, the fees, the time it takes for the funds to be distributed, all of that. This takes a long time. It's really slow. It's expensive. Yeah. Like
YouTube will take a margin.
Exactly.
Huge margin.
And that's the thing, though, like, and for them, they end up making a ton of money because they're the ones that have to facilitate this. There's no other way for me. I mean, don't get me wrong, there's probably other third parties I could use to facilitate it, but I have to go through them. And then, yeah, so I'm almost at the liberty of what they decide that will determine whether my business or my app will be profitable or whatever. And I think it'd be interesting that people can build these independent services that can be, and I say this too because a lot of people get really mad at Apple. Like people will build interesting apps and then Apple will kick it off the App Store because they don't like it or something. And then it's just like, well, how am I supposed to have my application run? And people being able to execute it directly, whether it's through a browser or whether it's Android, gives the people who built the applications their own. It gives autonomy to the people that build the applications to be able to profit from their own efforts without having to, like I said, give off these margins to these third parties just to facilitate this. Like it's not even like YouTube's not the one that's running my channel. They're just going, hey, look. We'll make sure that any money that comes through here. I mean, don't get me wrong, they have a whole ad platform, but the biggest thing is they're just providing the infrastructure. And sort of what I was saying before, decentralized infrastructure is cheap. It's cheap for everybody. Like you don't have to spend all this money hosting all this. And I say this, I say this because in my professional career before I got into crypto, I was an AWS developer, cloud architect. Everything I did was cloud infrastructure. And just seeing how incredibly complex and expensive, especially especially when you talk about payments too. Payments are a whole mess. The cost for operation is insane. So just the mere fact that you can have apps that almost run for free, or at least you have little to no margins that are coming out because the network fees are so cheap.
Exactly. I mean, you could say that YouTube brings you the advertisers who will fund basically the whole process, but there must be a way to do that in a decentralized way, like Discord or others. They are purely infrastructures, and you with Twitter also, you're attracting your audience yourself. You don't need a middleman for that, basically.
Absolutely. That was my last question. So that was my last question. I really want to get your opinion on that. I'm really glad I was able to have you on, and maybe I can hopefully have you on again at some time. I love picking your brain. I really wish I had a chance to pick your brain sooner. But I love being able to chat in the space and be able to see what's new and what's going on, and everything you have to say just has me in a daze. I'm just like, oh my goodness, like, but no, I just love having these conversations, especially with people that are so established as yourself. So thank you so much for coming on.
You're welcome, Quincy. Great to join your stage, and looking forward to indeed coming back and reporting on the progress we're achieving with the bigger banks. Indeed.
Yeah. Is there any last things just the chat's watching now, any last things you might want to just address or say, or just, I don't know, words of encouragement, I guess?
No, there are, innovation is a process, sometimes can be a painful process. We tried out a few things, didn't work. We're coming back with a few ideas and new tokens to basically make trade finance more investable. So expect more news to come from the TFD initiative, Trade Tech, XDC network, all of those players. We are on a mission to make indeed trade much more accessible to a wider range of investors, and all the topics we discussed, and retail and this and that, tokenization, smart contracts, all of this is coming very soon. It's a matter of finalizing some product launch stuff. So there is more being built, and we are doing something quite unique. I can say we are enjoying a lack of competition at this stage. So definitely the focus of XDC and TradeTech, of course, but also XDC network as a generic blockchain layer one on trade finance is definitely becoming more and more concrete. It was a vision a few years ago, and then building blocks were being delivered, but now, and in particular, thanks to the partnerships with different players like Propine in Singapore, TradeTech in UK, and there are more and more capabilities being delivered. So it's really delivering on its mission, basically. But we can't do everything in 2 years. So there are processes that take months and attempts that fail, but then we start again and we're getting there.
Absolutely, absolutely. I love it. I love it. Yeah, everything's been coming together really like kind of really well. Just seeing all the different things going on in the network. I've actually seen some startups utilize like trade tech, or not trade tech, trade trust, and some other services. So even seeing third party services starting to tap into already established projects is really exciting. It's really exciting, and there a lot of the projects that I see, especially on XDC, they're very like solution focused, very much like akin to like startups in a sense, where it's like, oh, here's this business solution, here are the big boys that do it, but we could do it better. And I love that actually. It's cool seeing the innovation that's being had at all levels. The big organizations all the way down to these small startups that may utilize smart contracts deployed by them.
Yep. Yeah. So it's very encouraging, and yeah, this year we definitely going to already hopefully in quarter 1, maybe quarter 2, we'll see. But going to announce very interesting things or launch very interesting things.
Awesome.
More
Awesome.
later.
Yep. Yeah, there will be more later. Yeah. Come back next time on your Pro Quincy, and we'll be able to talk about that. No, you have me so excited. And I say this because you probably see a lot of the silliness in the space where people are getting all hyped about whether it's like price predictions or getting hyped about just all sorts of stuff. It's just nice to be able to have a conversation on just solutions and what these things can do and what people are doing with them and what it means and contextualizing it in a way so regular people can go, oh, I see I see what you mean by this adoption or this or whatever. Because I feel like the space is confusing, but not because it's confusing, but because there's a missed idea on how these things can have an impact on us. And I feel like you either have to be a developer or have to be in finance or have to be in the space to get a perspective to where you're like, oh, actually, and then start diving into all the different, like I said, it's really abstract. So like the example I like to give is imagine being in like 1999 and explaining to somebody that Linux will be the future. Like every major machine is probably gonna be running Linux. But then a regular person thinks, oh, that means we're all gonna run Linux desktop and Microsoft and Apple are gone. And it's like, no, yeah. But you know what I mean? Like it's like there's so much, it's hard to explain because it's abstract. But once you get into it, it's like, oh, you can build websites, you can build robots, you can use this as the base operating system for the TV screen that you're watching on. Like once you start looking at that, it's like, oh, and I think that the same thing's gonna happen with tokenization and blockchain technology, where it becomes less direct concrete and starts becoming I don't know if relatable is the best word or the best phrase, but you can see how, like I said, the payments instantly or payments on the weekend. I think there'll be certain services that people will be able to recognize that this technology is able to facilitate, and I think that's going to be something that's going to help move the space forward, and especially in maturity, as well as like find more people to be interested in crypto, find more people to build, grow, all of that, you know?
Exactly. Yeah, indeed.
Awesome.
Well, great to be here.
Yeah. So good having you. I hope maybe in like a month or so I could bring you on again, see what else you're up to. I can't begin to tell you how much I love this conversation, and the chat seemed to be loving it really well too. So it went really well, and just thank you for your time and just giving me the chance to just talk with you for a little bit.
Thank you. My pleasure, Quincy, and talk soon and keep in touch in the meantime.
Definitely will.